and how that applies to you guys in real estate. We're going to be talking about tech stocks. I know there's a lot going on there. I don't know if you've been riding the Nvidia wave at all, but we've got Nvidia, we got Apple, we got Amazon, and we got Google all making news. We've also got some stuff going on right now. We have tipped the corner a while ago, but now there are a lot of states where inventory has been building and prices have been dropping. We're going to be going through the top 10 states that have turned the corner. If you're looking for places to invest, we're going to be talking about that. We are also going to be teaching you guys a little bit. We've added a teaching component to this. So today we are going to be going through how you can do back of the napkin, fast 2-minute math, both for single family and multifamily. We got a lot to jump into. Nate, what's good in your world? What did you do this weekend? What are some wins that we can cover real quick?
Okay, so I'm not a crier at all, but I had a movie that caught my attention that I'm going to give plugs for, and I don't normally do this, but Unsung Hero. Take your family, go see it. Amazing movie. It's Christian based movie, but it's true story of a family that moves from Australia to the United States, and you'll know it. You'll know the characters once you see them. But great movie. That's one of the big things I did this weekend.
Nice. My win, I spent the weekend back in Texas. Went back to visit my girlfriend and get things ready to move back there at the end of this month. So super excited about that. Texas is still hot, Nate. Still over 100 degrees. I don't know how they do it, but
As is Florida, my friends. It's just you gotta just say thank you, God, every day. Thank you, God, for the sun, and just embrace it.
I right now I was pretty thankful this morning. It was 55 degrees outside, had a good morning hike, light jacket, and I was pretty thankful for that. All right, so we're going to go ahead and get started. How do we start everything here at Home Invest, Nate?
Do you want to lead us today, Steve?
Sure, I'd be happy to. If you guys, we always start everything with a quick word of prayer. So here we go. Dear God, thank you for bringing everybody together today. God, please bless Nate and myself with the words to say to help people build generational wealth and build inheritance for generations to come. God, please help us to make the confusing simple and to bless these people with some knowledge. In your name we pray. Amen. All right. If you are new to the show, if this is the first time that you are tuning in, the gentleman joining me is Nate Armstrong. He's the founder and CEO of Home Invest. We are a real estate company. We are based on the principles talked about in Matthew 25, which is the parable of the good steward, teaching you how to double your wealth through savvy real estate investments. We don't care whether you invest with us here at Home Invest or if you invest with somebody else. We just want to make the world a simpler place. We're pulling back the curtain. We're going over the biggest news stories and we're showing you what you need to know, what is real, what is not, and why. All right. Hey, what's our latest opportunity? This is called the opportunity zone. What opportunity do we have for people this week? Got something a little
Yeah,
different.
yeah, this is a little bit different. I'm going to draw it out. And additionally, huge win, our machine shop. Every time that we brought forward our industrial fund, the manufacturing fund, machine shops for short, it's filled up really fast. So thank you to all of our partners. I see some of our partners on now. Thank you guys. We appreciate having you. And it's not surprising that it fills up pretty fast because thank God the economics for that business right now, they're working in our favor. They're doing some incredible things, and we actually have more good news that we're going to be sharing with all partners soon. So machine shops are completely full. So the last fund tranche that we opened up, we're filled up. Can't take any more money on it. So we were trying to think like, where could we actually access or provide an opportunity for people for this week? And we have one spot where we could provide some opportunity for people. So I'll outline that. We have an investor who's been with us for a while, who he has some properties that he owns free and clear, meaning there's no debt on them whatsoever. On those properties, he would like to take some equity out of them. And he'd like to take that and invest it into our next multifamily property. And so what he's basically done is he came to us and said, hey, I talked to him over the weekend quite a bit. He said, hey, Nate, I've got these properties free and clear. If you happen to have someone that wants to be a lender, then I'm open to that conversation. And so we're working on a structure where we can get involved and we can help manage these properties and things like that. But if you're looking for a short-term commitment, somewhere that you can park some cash and get immediate dividends from, meaning in monthly payments coming to you each month, then this opportunity might be right for you. What I'll do is I'll zoom in, I'll have the camera follow me back over here, and I'll zoom in up on this board over here. And what we're going to do is I'll draw it out. Okay. So it works like this. Basically, if you're looking for those monthly interest payments, it would look like this. If you come in for $100,000, it would be 8% payments every single month that come in to you. It's secured. I'm going to write this in big letters because this is important. When I'm looking at potential investments, when I've done private lending like this, I always want to make sure that there's some kind of collateral. It's secured by real estate that's owned free and clear. So what that means as an investor is that it can't disappear. It's not like a stock. It can't one day the company goes under or the stock just cuts in half. This is secured by real estate that has real value. It has rental income coming in on it. Like it's solid. And there's a ton of equity in these properties. The loan amount that we're talking about doing on this is barely over half of, it's like less, it's around the halfway point on the value. So there's a lot of room. It's a very safe position. So 100K, 8%. And then the other bucket is for those of you, and we have some folks that like to do this as well. If you like to put in more dollars, there is an option to do $1 million, and that pays out at 10%. Okay. This is short term. This is not a 10-year project or anything like that. This is more like a 3-month to 12-month opportunity. 3 months minimum, 12 months maximum. Why such a short term? Because this loan that someone's going to make is going to get cashed out by a bank that will make a permanent loan on the property. This is only a short-term opportunity. Okay, with that said, Steve, maybe we just put up the link in the chat. And if somebody wants to talk about it, we're happy to talk to you guys about it.
We will drop the link in the chat for you. So this link will go to myself or to Sue. Sorry, I'm just getting it copied so we can get it in there for you. This link will go to myself or to Sue. Sue got it in there for you. If you click that link, it will get on with either of us. Either of us would be happy to talk to you about it. If you have any questions, I know it's something a little bit different. We'll be happy to speak to you. All right, Nate, let's keep the show moving. So we're going to jump right into news. We've been talking about the stock market. We talked about it a little bit last month. We talked to it the month before as well. There's been some crazy things going on. A lot of movement up and then a little bit retraction. What is coming right now and what's going on with Warren Buffett? Let's start talking about that right now.
Well, Mr. Buffett's making moves. If you guys haven't seen yet, 2 things have happened with Mr. Buffett. Number one, his company became worth $1 trillion, which is the first non-tech company to get that kind of valuation. So it's huge. This man that's been conservative and lived in this small, simple little house in Omaha, Nebraska his entire life, he just hit the $1 trillion mark. So congratulations, Mr. Buffett. He's doing a thing right. Now, why did he make that mark? Because he's made incredibly good moves in the stock market. They're not complicated moves. He tends to buy low and sell high. Well, one of his biggest sales just started happening. It's been happening the last couple of months, but he made a huge sale. He sold a lot of his Apple stocks, and he's in this position now where he's very cash heavy, specifically in bonds. He's become one of the biggest bond holders in the United States. Why is he doing that? Well, I guess I don't have him here to interview Steve, so you can pretend to be Mr. Buffett. We can talk about that. But if you follow his Buffett indicator, which is essentially the stock market value divided by GDP, anytime that gets over 100%, like right now we're at 202%, we're way over what Buffett thinks we should be at, then the stock market has some risk to it. And it's my suspicion that he pulled back and started putting money into bonds because he thinks that something will happen with the stock market. I'm not a financial advisor. I can't give you financial advice like that. I'm just telling you what my humble opinion is. The man's moving to cash for a reason. And I think I'll show some data on it in just a second, but I think that's why he's doing it, Steve.
Yeah, I think I would agree. The market has been getting more and more volatile. And the stats that you're going to show, what happens? I mean, what do we have coming up in September? What has the Fed been talking about?
Rate cuts. are right around the corner. This month we will do some kind of rate cut. I don't know how much it will be, probably a quarter point, but that's what's happening right now.
I mean, they're finally getting around to cutting, which is good. But what happens to stocks and what happens to the market and the economy in general? Nate, you want to show some of that data?
Yeah, so I've got 75 years of data on this. I did a full-blown presentation this last week for a group of our investors, but I want to just hit it now, high level right now. Basically, every time that the Fed cuts rates, it's not because it should not be this big like cheerleading session. I know a lot of people in the market right now are thinking, oh my goodness, this is great. This means that, we should celebrate. It's actually the opposite. The reason that the Federal Reserve raises rates to begin with is because they're trying to slow down the economy. It's like if you think of kids at a birthday party with a piñata. My wife's turning 41 pretty soon. We might have a piñata just for fun. And you hit that piñata with the stick. The Federal Reserve raising the interest rates is the kid with the stick. That's what they're doing. They're trying to hit that thing and slow it down. So that's what the Federal Reserve has done by raising interest rates. And usually what happens after rates, like you see Warren here, buy low, sell high. Usually what happens after these rates start getting cut, this is 2007, rates were cut, and we fell down fast on rates. Usually what happens is that the stock market might have an immediate reaction of an upward swing, but then right after that, the market comes down. And if you look at 2007, which is this snapshot right here, what happened right after rates were cut last time? Well, we entered the longest or biggest bear market in modern history, 2007 bear market. And that wiped out a lot. I remember I had a 401k from my former corporate job, and it cut in half. It cut in half during that stretch. So I'm not the doom and gloom guy saying this is what's going to happen, but I just have to pay attention to when I see Warren Buffett, giving a signal that he might think that the stock market's going down.
Yeah, I think that is good information to heed. If you own stocks, should they mirror what Buffett is doing? Is there something else that people should be doing with stocks? I know it's all kind of crystal ball talk, Nate, and I know we love real estate. What should people be doing?
Yeah, I wish I could answer that question. I'm not a stock guy. I'll tell you what, the stock guy that we have, it's kind of one of our in-house guys. We're shorting right now. We're taking short positions. We feel that the market's really, really bloated. And so we're shorting different positions, and that we're not going to invest a ton of money into it because we believe in real estate, but any positions we take in stocks, we're shorting.
Got it. All right. So we went through what Warren Buffett is doing, and we talked a little bit about the tech stocks. So the big tech stocks, they're the companies that are propping everything up right now. I don't know if you have that infographic that we had up. Nate and I were talking about this. Right now, the market is basically propped up by a handful of tech stocks. Everything else has kind of been doing pretty poorly. And once those tech stocks start to falter, we're going to see it all kind of fall apart, is my opinion. I actually followed Warren Buffett's lead. I held Apple, and I had a little bit of Google and a little bit of Amazon. And I dumped all of it over the weekend. I think that that better,
No,
Nate?
no, yeah, that's better.
You're back.
Awesome. Did I freeze or did you freeze? Doesn't matter. We'll keep going.
The show, man.
The show always goes on. That's what happens when you do live shows. Okay. So moving on from the stock market, something that is a major change in the way Americans buy homes, they are introducing the 40-year mortgage. Nate, what do you think about the 40-year mortgage?
Well, considering the word mortgage, the root of it, it's a French word. It literally means until death. If you take mort, which is death, and then gauge the commitment until death. And so that's what I've always thought of the 30-year mortgage. Now that we just stretch this out a little bit further, I think it just causes more debt longer. I don't like the idea for society as a whole. So I'm opposed to it for that reason, just from a fiscal responsibility standpoint. Is it going to help more people? It probably could, because right now with rates being so high and prices being so high, the monthly payments are unaffordable for a lot of the average Americans that are out there trying to get home loans. So it could open up the door and it could let more people get into loans. I don't like it though. I'm a big thumbs down.
I mean, I would agree. Like it might get people in right now, but what it does in the long term is now people's equity builds a lot slower. Where do most people get their wealth that they're spending, right? They build up equity in their house, then they take out a home equity line or they sell it and they have access to that cash. They pay down their credit cards, they pay things off, they go on vacations. If we go to a 40-year loan, that just means equity is going to build longer and they're going to end up paying more in fees. They're going to pay more in fees and more in interest. It solves the short-term pain, but it actually builds long-term loss. I don't like this at all. I think that it is people just kicking the can down the road. And it goes back to like the right hand and the left hand, right? The Fed raises rates to slow down inflation, and then they come up with a product, like the market comes with a product that just allows people to sidestep the rate change. It'll keep rates higher, in my opinion, longer, because it's going to cause less change in society. I don't think it's a good long-term play at all. I think it's the same as like a payday loan. I don't like it. We both give it a big 2 thumbs down from Nate and Steve. What do you think this means for investors, though? That was Emily posed that question to me when we were talking about it. It's interesting because if you can do the house hacking thing, do you think this would push up cash flow for single family investors?
Yeah, absolutely. I mean, a lot of people they'll go after as the investors, they'll even take things called IO loans, interest only loans. And it's kind of like renting the money instead of having a set deadline where you're going to pay the principal down every single month. You're essentially just paying interest off of it. And yeah, if you're cool and the business plan supports that, cool. A lot of people they lease real estate and run their business out of it. Think of most McDonald's in the country. Usually there's a separate corporation that owns the actual real estate and leases it to the franchisee. There is a way to make money off of that if there's an intention from a business mindset. So I think that single family investors can benefit from it as well.
Yeah, I think that's the one place that I like it, because you as an investor, you can definitely do more because you're going to have greater cash flow. I do think that the banks are going to end up being the big winners here. They're just going to be the ones that keep rates up. And they're going to make more money because you are locked in for a longer term of debt. If you're using it as an investment vehicle, though, I think it does make some sense. I just think it's funny. There's so many people cheering this on, but it's like they just don't see what they're actually like the pain that it's going to cause them long term, which makes me sad. All right,
Steve, I did find that image that we were talking about. So the most valuable companies right now that are propping up the stock market, it's these companies in blue. You're talking about Google, which is Alphabet, Amazon, Nvidia, Microsoft, Apple, Meta, which is Facebook, and Instagram. These companies right here are towing the majority of the stock market up, at least the S&P 500. If you look at indexes, it's not the all companies combined. It's literally these tech companies. They're pulling a lot. Nvidia has done some amazing things in the last year. So this is like, if there is a fallout, if these interest rates come down, and let's just say that the next few jobs reports come out and it's starting to look kind of ugly, which is what happened last time they lowered the rates, 2007, then I suspect that those would be the ones that start to trim, so to speak.
Yeah. I mean, the other thing is like, is Apple overvalued? Like those are we're not a stock show. We're not going to get into all that, but between Nvidia, Apple, and Google are they overvalued? I mean, we can throw Amazon in there as well. Apple's probably the one that gets talked about the most as being overvalued. And we'll see. I mean, as the market changes, we'll see what happens with it. All right, the last bit of news that we got, I like this one a lot. We will share here. 10 U.S. housing markets where buyers have the most power right now. Lubbock, Texas, making front page. I don't know if that's somewhere that you would want to live or buy. What about Punta Gorda, Florida, Nate? What do you think about Punta Gorda?
It's so interesting because Punta Gorda was like the gem of Southwest Florida. I'm not saying that was the gem to live. I'm saying it was the hot spot. People were going after it to buy it. Just 2 years ago, 3 years ago, it was hot, hot, hot during COVID when people were moving from up north to down south to get away. Punta Gorda builders were having a field day. Now it's interesting to see the flip happen that fast. And I think it's kind of rightfully so. They just overbuilt and there's not very much demand for that area. It's more of a tertiary city. It's out there. It's between two major cities, but by itself, there's not a lot of landmarks that people are going to Punta Gorda for. So now you're seeing big discounts happen.
So we talked about Punta Gorda last time, or maybe 2 weeks ago on the show, because you showed it in 2007. It was one of the first cities in Florida to have a major correction, and now the correction is happening there again. And I think it's because it's one of the cities that is an outlier. It doesn't have a lot supporting it. Lubbock is probably the same. I do think it's interesting that 9 out of the 10 cities on there are in Florida. What do you think caused that? The heat?
Florida is still a great place. It is. But if you look at history, Florida has up and down cycles. It's like going on a roller coaster ride. You get some of the biggest ups and you get some of the biggest downs. If you plot that over maybe just an average period, it's not that crazy of a ride, roller coaster ride, so to speak. But Florida does have big ups and it has bigger downs. And that's part of the thrill, Steve, of living in Florida.
The thrill, along with alligators and bad drivers.
Yesterday, I took the boys to the playground and my son was about to jump from one thing to the climbing wall. And there was a snake on the pillar that supported the climb. I'm like, on the pillar? What the? So we both jumped off really fast. Needless to say, we backed away from the snake.
All part of the excitement of living in Florida. I know Ralph is on here as well in Florida. Chris lives in Florida, has all the fun. Man, you guys down there, snakes, alligators, heat, humidity, and now you have 9 of the 10 cities with the biggest price corrections. Are you guys, I guess the question is, we've had a lot of investors saying that they would like to buy something in Florida. They'd like us to take something down there. Are we looking at anything? Do we have anything in the pipeline, Nate? I know the answer to this.
Yeah, you see Chris and Doug both nodding. Doug's got a smile on his face even. Look at this. Yeah, these guys have been working on some deals. We've been placing a lot of offers. We don't have one ready to present today, but as soon as one that meets all of the metrics, the ones that get our investor base excited that we know we can deliver on, we'll certainly publish it for everyone.
Yeah, it's coming, guys. Right now, though, let's go back to what is our opportunity that we have for people. I know this is something a little bit different. Nate, maybe you want to do the fancy camera trick and step back over the whiteboard and run through it. For the people that are just tuning in right now, people that are just tuning in, if this is your first time to the show, his name is Nate Armstrong, the CEO and founder of Home Invest. Our mission statement is to help you build generational wealth following the principles in Matthew 25. My name is Steve Warner. I'm the Chief Investment Officer. Nate, let's go through what we got for him because this one's kind of fun. It's something a little bit different.
Cool. So it works like this. We have some real estate right now that's paid off free and clear. One of our partners wants to contribute it so that he can use that money to invest in another deal with us. And a lot of times we have investors that will come to us, maybe it's you, that say, hey, I'm looking for a shorter term opportunity, something that pays monthly payments every single month. If you are looking for a shorter term opportunity, like a 3-month to a 12-month duration, and something that can pay you monthly cash flow every single month that is secured, then pay attention to this for a minute. So our partners bring in these properties to us that are owned free and clear. They're rental homes in duplexes and triplexes that have tenants in them paying rent every month. We're looking for someone that wants to come in as a lender. Basically, you with your cash, bring it in just like a bank would. The safest position in the world, at least per banks, is to be the lender. So literally you'd come in just like a bank would, you'd provide cash, you would get a first position mortgage on the properties or deed of trust, depending on what state you live in, you might refer to it as that. And you would be securitized. So if you're looking for a short-term project that pays monthly passive income, this one is paying out 8% on $100,000 investments. If you're someone that likes to write a larger check, $1 million plus can get you 10%. We don't have these opportunities available very often, but this is one that's available right now. If you want to talk about that, just book a call with us. Either use the link in the chat, or if you're following us online, then type the word call, C-A-L-L, in the comments, and we'll send you the link.
Awesome. Sue put the link in the chat. You can click that link. It'll get yourself on a call with either myself or Sue. Either one of us would be happy to talk to you about this. It is something unique, and it's not something that we offer very often, but that's our job, is to bring you great investment opportunities and to give you different opportunities throughout the year. All right. We're going to jump into teaching. So people always ask us how we have done so well. Nate, you've been active in real estate for more than 20 years. I started in 2002 after reading Rich Dad, Poor Dad. We're going to talk a little bit about single family and multifamily, how you estimate what the property is worth, as well as rehabs. We do back in the napkin math, so we don't spend a long time. At Home Invest, how long does Kate, our acquisitionist, spend analyzing a property when she first gets it?
So this is first glance. There's two levels of research. A lot of people were explaining this because if you're going to go out there and hunt down deals, you could literally spend all day looking at one deal and you would just burn a whole day. So what you have to do first is have a quick screening method, and then you have a later due diligence, like a deep dive session where you can get into properties. Our quick screening, we're averaging 7 minutes per property. Quick screenings, 7 minutes. Okay. So what does that look like? Number one, you're trying to figure out what the cap rate is, capitalization rate for short. Essentially, what is the return on investment, not factoring debt into the equation? You got to be able to figure that out fast. You got to know what neighborhood should trade at. And then once you understand that, then you can actually do that quick 7 minute screen.
All right. Do we want to walk through what is the cap rate equation, Nate? This is for multifamily.
Yeah. So I'll see if our cameraman will follow us, and we'll go over to the whiteboard right here. And cool. So we can zoom in. So last week we had an example property, and someone brought it. I think Kate brought the property, and she had two variables for us. I better not do that right now. Actually, I'm going to do this, Steve. I'm just going to talk about it up here. She had two variables for us. She had variable number one. She knew what the net operating income of was the property. What that essentially means is how much is it rented for minus all of the expenses. And the property she brought, I don't remember exactly, but I want to say it was around $207,000 net operating income. Okay. What we did is we took that number and we divided it by what the seller was asking for the property. If you don't know what they're asking for, you can come up with some different things for it, but you're essentially trying to figure out the value of the property. So if I take her property as an example, if you know the net operating income is $207,000, you type that into your calculator, 207,000, and you divide it by what the seller is asking for. So I'll click divide. And in her case, I think it was like $2.5 million. I'm going to put that in the calculator, $2.5 million. And then you click equals. You're going to get some percent. Okay. You move the decimal place over 2. So this one's 0.08. If I move the decimal place over 2, it would be an 8.28% cap rate. And then you just have to look at it. You have to say, hey, does that cap rate make sense? On her particular property, it was a C class asset, which is kind of like average working class housing. An 8 cap, 8.2.8%. That's really good. That's favorable. So on that one, that would pass our 7 minute test, and we would take that one into a deeper due diligence session on it. If it was like a 3 cap or a 1 cap, or maybe even a negative capitalization rate because it's not cash flowing, we would walk away. We would just screen it out and go to the next deal. Is that helpful, Steve?
That's awesome. So you guys can memorize that formula. That's super easy. So NOI, what is it one more time, Nate?
NOI divided by, just call it asking price.
Yep.
It's actually divided by value, but if you don't know how to determine the value, you'll be lost. So just NOI divided by what the seller is asking for it.
And what is a general rule of thumb as to what they should be looking for in a cap rate? Like 5% or 5%, 5 cap, 8 cap, 10 cap? What should they be looking for?
If you find a Florida property on the water that is a 7 cap or higher, you should come running to us and say, hey, I want to take this deal to you guys. That's what you should do. So what does it really look like? It depends on the asset class. If you're talking about class A, beautiful buildings, like right now, we have a billionaire that's looking at a property. We showed him a C class. I sent it to him. He laughed at it. He's like, why would I ever want to do a C class? C class I happen to like, but I'll put my preferences aside. This man owns hotels. Like that's what he has. He wants a class A property. Class A is trading, depends on the location, but it can trade anywhere from a 1 cap to a 4 cap, maybe even a 5 cap. There's a lot of variables that go into it. Class B, that would be like your next level down, not necessarily your executive front row ocean view kind of stuff, but one level down. Class B can go anywhere from a 4 cap to a 6 cap, somewhere in that range. And then class C is anywhere from a 6 cap to sometimes a 7 or an 8 cap, maybe even a 9 cap, depending on the asset location. So there's variability to it. Does that answer the question, Steve?
Yeah, I think that's pretty good. Just so that people understand. And then how do you determine rehab when you're doing back of the napkin math? Do you determine rehab costs on multifamily? Is there anything that you do there?
Yeah, when I read the offering, or if I'm talking to the seller direct, I ask questions on, hey, what have you done to improve the place since you bought it? What's left to be done? If I can't get that information, then I usually I'll still just do the math and not even think about it until the next level. But if I can get that information and I know there's a huge repair problem ahead, then I'll factor that in. If they're asking 12 million for the asset and I know it needs $1 million in upgrades, I'm going to use my number as 13 million, 12 plus 1.
Awesome. All right. So that's multifamily. Do we want to talk about single family at all? What do you think?
I think this crew here, they're like, you guys are super smart. You guys are up here. They're beyond single.
Okay.
But the real reason is that single family, like if we look at it compared to stock market, compared to multifamily, et cetera, or commercial in general, I'll just pop this up really quick, Steve. Single family right now is at an all-time high. Like literally for price points, you cannot find a higher time in history than right now. Single family is sitting up there. And there's a lot of reasons for it. We don't have time to get into all of them right now, but the government banned foreclosures on VA loans, as an example. The government has a Band-Aid on FHA mortgages right now. They're not being foreclosed on. There's a lot of reasons single family is super, super high right now. But on the other hand, commercial dropped. When interest rates went up, the Federal Reserve, remember, they're that kid with the stick and the piñata. When the Federal Reserve raised that rate, it killed commercial. Commercial was already going down because of office space. Office space got crushed during COVID, but between the two, like it just crushed the commercial real estate sector. And so if you're following Warren Buffett's strategy where you buy low and sell high, you don't want to buy single family today. Instead, buy commercial. Commercial makes so much more sense. Like on average, we're seeing that it's down about 37%. I won't get into each category, but apartments down about 30%. You can see on this graph. And then office space, 35%. Office even dropped a little bit since I took this screenshot. So the real deal right now is in commercial real estate. And that's why I won't talk too much about single family. Single family will have its day. It's just not today.
All right, cool. We'll come back to that sometime in the future then. All right. So there you have it, guys. One of the questions we get all the time is how to analyze multifamily. We'll actually go into a deeper dive on this. We'll talk about T12s, T3s, rent rolls, and expense reports in a coming episode. But right now, just doing back of the napkin math so that you can know if the offering is way off. I will tell you, if you're finding stuff that is already listed online, if you're looking at Crexi or LoopNet or something like that, chances are if it's posted there is because everybody that was on the off-market list passed on it and it's not going to be a great deal. Doesn't mean you shouldn't make an offer on it, but it does mean that the numbers probably are not going to be great. Nate, we've got something special coming up next week as well. Do you want to talk a little bit about what we have coming up next Wednesday?
Are you talking about the special webinar that we're going to do?
Yes.
Paige pushed it back one more week because I got assigned to jury duty. So
Oh,
jury duty special. Yes, I know. But I don't get to do the special webinar until the week after. But the week after, we're going to be coming through and we're going to give all of the data. It should coincide with right around the time that Jerome Powell is cutting the rates. And there's going to be some market fluctuations. We're going to see some, who knows, that kid with the stick and the pinata. We're going to see some things pop out that week that we probably need to plan for. So we're going to bring all the data to you guys first as we're seeing it. So if you're a data geek like me and you like the analytical side of the business, then tune in for that. That'll be in about 2 weeks from now.
all right. So we're probably looking at the 18th or the 19th for that. We're going to be doing a special report. We get a lot of people interested in those things because we focus just on one topic. So that'll be coming up about 2 weeks from now. All right, guys. This is going to be your last chance to book a call with us. If you'd like to jump on a short call to discuss the special opportunity that we have, where you get to come in and play the role of a banker, get a monthly payment for a short-term loan that is collateralized by hard assets. That's our option for you this week. Nate, you want to run through it high level one more time for us?
Yeah, if Sue's on, Sue actually put a comment in that Sue said, I started as a private money lender for Nate. Sue, are you there? Could you define what that is, just kind of in simple terms? I probably
I'm going to pull Sue up. Give me 1 second. There we go. Sue, you're looking sharp as ever.
Hey guys.
Sue, what is this private lender thing? And then for anyone that doesn't know you, we should tell who you are.
Well, I always liked being a private money lender because it sounds nicer than a hard money lender. So that's why I always chose the word private money lender. But yeah, guys, early on, Nate was flipping properties throughout the Twin Cities, and I met him at a class, and I did my own flip, and it turned out great. But man, I was totally burnt out, and so I just called him up and said, I have $70,000 in cash. Can I be a private lender? And I just, he was paying 12-14% back then, but it was a different time than we are in today. But yeah, and then he'd be, Sue, do you know more people like you? And that's how I started raising capital, but I loved it because I could take the equity in my house. I had a HELOC. So the equity in my home was making interest, even if I had to pay 4.5% interest at the time. It's, my property was making the money, and that was just awesome for me. And I used other people's money to make money.
Cool. And Sue, just the mechanics of it, just so people can kind of get their arms around it. I explained it very, very high level, but essentially if someone wants to be a private lender, they don't have to be a bank. They don't have to have a license. They don't have to have special credentials. It's literally a person like you or I. Is that correct?
Yes. I mean, do you want to work with accredited investors, Nate, or are you taking anybody?
So accredited is the idea. If someone could hit the sophisticated mark and they could do a loan, then that'd be okay too. But accredited is the idea.
Yeah, and guys, it's great because you have a promissory note that has all the terms of the loan written out. How much you're going to get paid, what is the loan secured by, when is it due, and then you have a mortgage document which gets filed with the county, so there is a lien on the property, and you're the mortgagee. I always get those two mixed up, and then you get your monthly interest only payments, and then usually about 30 to 60 days before your note is due, then you'll type up a satisfaction note. What do you need to get satisfied? And then, you sign the mortgage satisfaction. I'm missing one piece. What's that piece in between?
Mortgage, promissory note. Those are the two main documents for everyone.
You got to do the release too. So what you need to release the mortgage. So, but yeah, I mean, I did that all along for boy, for a number of years, because that was how I helped build my capital so I could start doing the larger investments.
Sue, our CFO, Kate, she's about to join the ranks of being a private lender. So she's probably going to reach out to you for advice, Sue.
Seriously,
Wow.
I've been telling her to do it for years. It's about time, Kate.
It is
Yeah.
about time.
So
Next thing you know, she'll be flying.
if all that sounds interesting to you, if you guys are looking for a shorter term commitment, 3 to 6 months where you can get monthly interest checks, this is a rare opportunity. We literally don't broadcast stuff like this, but we just happen to have a partner of ours come forward who has a lot of equity in a lot of real estate, and he could use that equity to invest in a deal with us. So if you look to do a short-term deal, that's the deal. So you can use the link in the chat or type the word call in the comments, and our team will send the link to you if you're on social media.
Awesome. All right, guys, the link is in the chat if you would like to book one of those calls with us. The other one that we have for you, Nate, Sue brought this up, and it is something worth talking about. There is a different kind of exchange out there that you can do that most people haven't heard of. Nate, do you want to unpack this one? We've got a little bit of extra time today.
This one might be a full-blown webinar for this, but there is another exchange. Have you guys, let me know in the comments if you've heard of this, okay? Did you know that if you own real estate right now, particularly investment real estate, there's a way that you can sell it tax-free without doing a 1031 exchange? Did you know that? Yes or no? Just put a yes or a no in the chat. I just want to take a quick survey. There's another way you can sell real estate tax-free. Like literally, I love these things. I geek out on them. I love tax-free ways of living life. I don't like the federal government sends our money around the world and does craziness with it. So I'd rather figure out tax-free ways to do things. Okay. All right. So Vince says no. Mark says no. VM says no. Roseanne says no. Mike says no. All right. Cash Buyers Club. No. So it's not seller financed. It's something that's even better, in my opinion. So I will take. Oh, go ahead. Sorry, Steve.
Go ahead, Nate. You're good. We can hear you over there. So we're going to go through this from a high level. We are going to do a separate webinar on this because this one could get pretty nerdy, but we're going to take 5 minutes and run through it from a high level. Nate, your mic's fine. You don't have to worry about it. You're good over there.
Okay. Just in case, I'm going to bring the traveling mic with us. So we're going to come to the board and we're going to talk about something that nobody talks about. Okay. This is like, it's almost secret, top secret. It's called an UPREIT. Okay. The technical IRS classification is a 721 exchange. 721 exchange. I'll zoom us into the whiteboard so that we can actually see it. Okay. UPREIT or 721 exchange. And it works like this. Let's just say that you've got a piece of real estate. You've been holding on to it for a while. It's appreciated. It's gone up in value. Maybe it's an apartment building, some 12-unit building. And, maybe you bought it for $1 million, but today it's worth $3 million. And you don't want to sell it because you get nailed for this huge, like $2 million tax gain. Did you know you can actually exchange it, not 1031 exchange, but this? What it means is that instead of you selling this thing and getting hit with that tax, you can actually work with the group. We do this for some of our investors. We're in the process of working one right now, where you take this property and you put it into a fund with us. Okay, so you become a partner alongside of us. We become the management team, taking over the asset, all the tenants, the toilets, the headaches, all that kind of stuff, and we collect the rent. Inside of this fund, you now basically start to get dividends from it. You get paid every single month or quarter or whatever the way that it's structured. It depends on how it's structured. But you get paid on that and you are a partner in the fund. Now, the fund has to keep this property for at least 12 months. This is the big one. Like if you look at doing this with our group or somebody else's group, just know you do not want them to sell it in anything less than 12 months. And the reason is because if they sell it short of 12 months, then what happens is that you'll end up getting taxed on that sale. Okay. You don't want that to happen. Instead, what you want is you want that group to hold it for a minimum of 12 months. If as long as they do that, then you will not get a big tax gain on your side. So Yeah, that's the essence of it. What questions should I answer on that though?
Is this something that might go away depending on who becomes president?
The 721 exchange, I've never heard it under attack. I've never heard of any of the current candidates like try to scrutinize it. I haven't even heard it in the House, the Senate.
I
None
don't
of
think
those.
anybody knows about it. That's the thing. This one
I
is
didn't
way
know
more.
about it. Yeah.
This one is way more under the radar than the 1031. I don't think they'll do away with either, but I think this one's pretty safe.
Yeah. Yeah, this one is amazing. There's another group in Kentucky. We do a lot of business in Kentucky, and I've been snooping around a little bit, getting to know the other group. They just do these exchanges, 721 exchanges, and watching what they've been able to build with it over time, it's really inspired me. Number one, like the reason that we're exploring it with another investor right now is this investor has worked on properties for a long time with his own two hands, and he's tired. He's ready to like actually be done working with his hands, maybe not entirely done, but like doesn't want to have to think about it all the time 24/7. And so for him to be able to hand off the properties to another group that's responsible, ethical, and is going to do right by him, it's a big upgrade because now the fund can actually use those properties, take equity from them, and buy nicer properties, buy bigger buildings, stuff that cash flows more with more stability. So there's really some good win-wins that can be carved out doing structures like this. We'll do a
Awesome. So-
full-blown webinar on it though sometime soon.
So Roseanne asked, what happens when you sell? And it doesn't have to be after 12 months. 12 months is the minimum hold time. But what happens when you sell on this, Nate? How are taxes paid then?
Yeah, as long as the properties are held for at least 12 months, then we should be able to do a tax-free situation for the seller.
Nice.
Yeah,
So
I
the
would-
seller would get paid out, like on the example you have on the board, there's $2 million in equity. Let's say they take payments on that for a year. And then there's, I don't know, we'll say there's 1.8 million left in equity. That 1.8 would be able to be paid to the seller tax-free.
So let me back up. First, I'm not a CPA, so I can't give like tax advice for anybody. None of us here can. I'm happy to talk with your CPA about this. If this is something you're really considering, then we'll do a three-way call and we'll work it out with your CPA. If someone has, let's just say 1.8 million in equity, as you mentioned, Steve, then what would happen is the property would be transferred into the fund, into the new structure, the 721 fund. And then the fund would now be the manager of it. And the investor who owned the property previously, they're now a passive partner inside the fund. They're entitled to dividends, distributions, profits, etc. Like everything except for being the person that's in charge of doing day-to-day management. They're entitled to all the benefits without the headaches of real estate investing. And then what happens with the fund is the fund operates those properties. The fund could take out a loan against the properties to pull out the cash and then buy another piece of real estate inside the fund. And now the fund just multiplies its real estate holdings essentially. So there's upside in that degree. Is that what your question was though?
Well, is it actually tax-free to them when they sell? Like when you sell, like, so now it's in the fund with us.
Mm-hmm.
How does it end? How does that fund end if the property
Well,
is sold?
as long as if it's less than 12 months, there's a taxable gain immediately. You'd pay tax on it just like you sold it. If it's after 12 months, then everything that I've been told by the attorney so far, then there's no tax liability.
Nice. All right. And then Mark asked, how long is Home Invest willing to hold the property? I mean, we would manage it for as long as we needed to. As long as it is cash flowing, I think we would be pretty happy. I don't want to talk out of turn, Nate. You're the boss.
Yeah. As long as it's an area that we can support, then we would. The right asset class, the right area. Like if it's in Nome, Alaska, we don't have any employees or team members in Nome, Alaska, so we couldn't support obviously there. But if it's an area that we can support and operate the property effectively, then we would look at it. So, but yeah, the longer the better for us. We like long-term holds. If we could keep everything forever, we would. Sometimes we have scheduled sales at the 3 to 5 year mark because it makes sense for our investors. But deep down, we like to buy and hold.
Awesome. If you guys want to ask us any questions about this, both Sue and myself can take calls on that as well. So I don't know if you want to drop the link one more time in there. If you guys would like to book a call, talk about real estate investing in multifamily, you can use that link. It'll go to myself or Sue. Both of us are highly qualified. Would love to chat with you about investing with us here at Home Invest. I think that is going to do it for our show today. We got into some weeds. We offered 2 new things, both the loan that we are willing to help you guys with and the 721 exchange. Happy to answer any questions with you. Wishing you guys an amazing Tuesday here as we get started in the fall season. We've got a lot of things coming up. Know there is a lot going on in the political race as well. We're going to be discussing that in about 2 weeks. We'll have a complete webinar that is separate from this going through that. So until next week, guys, take action, pay attention. I would sell your stocks. That would be my call. You don't have to. I dumped mine over the weekend, though. I think we're going to see some good opportunity in the real estate sector, like Nate was talking about. You guys can book a call with us, and we will see you next week on the Opportunity Zone. Till then, be great stewards of what God has given you. Practice Matthew 25. And we'll see you here on the Opportunity Zone. Guys, have a great week.
Bye, guys.